Insurance is a game of probability, but when a localized disaster strikes, like a hurricane hitting a dense coastal city, the math can flip. If the claims coming in suddenly exceed the premiums collected, the primary insurer faces immediate, overwhelming financial destruction. The traditional insurance business model is built entirely on spreading exposure. It relies on collecting a vast pool of premiums from thousands of different policyholders to safely absorb the cost of a few highly predictable, distributed losses. But probability isn't perfectly smooth. A concentrated catastrophe, like a massive wildfire or a coordinated cyber attack, can force an insurer to pay out far more in a single week than they actually hold in their cash reserves. This creates what the industry calls insolvency risk. Insolvency risk is the mathematical threat that an entity will completely run out of money and default on its legal obligations to pay its debts. For an insurer, it means total destruction of the balance sheet. To survive these catastrophic imbalances, a primary insurer cannot hold on to every policy they write. They have to structurally offload their excess liability to a secondary market. That secondary market is known as reinsurance. Reinsurance is essentially insurance purchased by insurance companies, allowing them to tap into massive global capital pools for protective coverage against their own extreme losses. The liability flows upward. A homeowner or business buys a policy from a primary insurer, and then that primary insurer passes a portion of that exact same liability up to a reinsurer. This risk transfer isn't free. The primary insurer must pay premiums out of their own revenue to the reinsurer, carefully balancing the cost of that extra protection against their own need to maintain capital liquidity. This creates a central strategic dilemma for risk managers. They must decide whether to transfer their risk in massive automated batches or to individually carve out and negotiate protection for specific high-stakes policies. Choosing the correct mechanism between these two paths dictates the insurer's long-term balance sheet stability and determines exactly how much daily administrative friction their underwriting teams will face. When an insurer wants to move a massive amount of predictable liability, they use treaty reinsurance. This is an agreement to automatically cede an entire predefined class of standard policies. For example, every single auto insurance policy written in a specific state for a given year. The outcome of this strategy is instant automated protection. As soon as the primary insurer writes a policy that fits the category, it is indemnified without requiring any individual review or approval from the reinsurer. The most common way this is structured is through a proportional treaty, where the primary insurer and the reinsurer agree to split the exposure on a percentage basis, up to a massive financial ceiling. This chart shows how a proportional limit distributes that liability. In a $100 million treaty, the reinsurer takes on 75% of the risk, leaving the primary insurer with 25%. That smaller $25 million segment kept on their own books is known as the retention limit. If the primary insurer writes $150 million worth of auto policies under this specific agreement, any policy written in excess of that original $100 million cap remains entirely their own responsibility, unless they negotiate additional treaties. Generally, higher retention limits yield lower reinsurance premiums. This forces insurers into a strict daily trade-off between maintaining their own capital liquidity and keeping their operating costs manageable. The defining feature of a treaty agreement is what the reinsurer completely skips. They perform absolutely zero individual underwriting on the specific policies they assume. This structure transfers a massive amount of underwriting risk directly to the assuming reinsurer. If the primary insurer's initial evaluation criteria were flawed, the reinsurer is exposed to those bad decisions without any mechanism to filter them out. In fact, a treaty agreement often legally binds the reinsurer to cover policies that haven't even been written yet, simply because they eventually fall into the pre-agreed category. But there is a distinct drawback for the primary insurer, too. Because it's a blanket agreement, they must pay reinsurance premiums on the entire class of policies, even the incredibly safe, low-risk accounts that likely wouldn't generate claims anyway. By selecting treaty reinsurance, the primary insurer sacrifices surgical control and pays broad, sweeping premiums, all to secure the automated operational scale needed to run a volume-based business. But standard consumer policies aren't the only risks in the market. Sometimes an insurer is asked to cover a single massive exposure, like a highly complex commercial skyscraper currently under construction. For these situations, they use facultative reinsurance. This is the precise process of carving out and securing coverage for one single risk, or a tightly defined package of risks, rather than an entire generic class. Imagine the primary insurer faces a $35 million liability if that single building is destroyed. However, their internal risk models dictate they only possess the capital to safely absorb a $25 million loss. Before they can even agree to issue the initial policy to the developer, the insurer must actively shop that remaining $10 million of liability to the open reinsurance market. This process becomes highly tailored. That $10 million liability is often sliced into smaller fractions, with pieces of the risk being absorbed by several different independent reinsurers, who each take a specific share. This surgical piece-by-piece process protects the primary insurer from taking on outlier financial events that exceed standard retention capabilities and threaten bankruptcy. The major downside of the facultative method is extreme operational friction. Because the stakes are so concentrated, the reinsurer insists on performing its own deep, individualized underwriting for every single transaction. Treating each policy as a one-off negotiation dramatically slows down the workflow. The primary insurer cannot quickly issue the final policy to their client while they wait for secondary approvals. There is also a severe risk of market rejection. Because it's facultative, reinsurers have the explicit right to review the specific exposure and simply deny coverage if they find it too risky. If the secondary market refuses to take on the excess risk, the ceding company may be completely unable to write the policy, forcing them to walk away and lose the business entirely. And if they only manage to secure partial facultative coverage, the primary insurer is often forced to retain the riskiest, least profitable fraction of the policy on their own balance sheet, just to push the deal through. Ultimately, risk managers should not view facultative and treaty reinsurance as competing products. They are complementary tools designed to handle completely different mathematical realities. Together, they form a unified two-tier filtration system that allows an institution to carefully optimize its overarching risk portfolio. This flowchart illustrates how this risk allocation routes in practice. The first step of the decision process filters for predictability and scale. If an insurer is managing a large, predictable portfolio of consumer auto or home policies, the system directly routes that risk to treaty reinsurance, maximizing administrative efficiency and keeping the business moving. The second step of the process filters for unusual exposures, or massive limits that simply exceed standard capacity. Underwriting corporate real estate, complex industrial facilities, or highly unique liabilities cannot be automated. This routes directly to facultative reinsurance for careful individual assessment. Standard consumer insurers require treaty agreements to maintain baseline stability, while commercial insurers demand facultative agreements to secure vital, customized capital protection for their biggest clients. The ultimate goal of any underwriter or risk manager is to optimize the exact ratio between their daily administrative cost and their total risk offload. Relying entirely on automated treaty agreements leaves an insurer completely exposed to catastrophic single-asset losses that blow past proportional limits. On the other hand, attempting to use individual facultative agreements for thousands of standard policies would paralyze the insurer's daily operations with unsustainable underwriting delays. Ultimate balance sheet protection requires perfectly matching the operational efficiency of the specific reinsurance tool to the complexity of the underlying risk. Mastering this allocation playbook guarantees that the primary insurer can honor their promises and pay out every claim, no matter the scale of the disaster, without ever facing insolvency.